What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined once again by the CEO of Osisko Gold Royalties, Sandeep Singh. Sandeep, how are you?
I'm good, Jay. I'm good. How are you?
I'm great. And I'm glad to have you back. I wanted to have you back on because I just caught up on your Q1 results, and these numbers are bananas, Sandeep. You guys are printing money right now, and I want to get into this because I know this is the results of lots of hard work in the previous decade, the previous bear market that's now paying incredible dividends. But before we get into that, I just wanted to jump into the gold market a little bit because as CEO of Osisko, you've got a really unique perspective. And 2021 began super sleepy after a really frothy 2020. And now just recently, we're seeing a bit of an uptick in the gold price. So what are your thoughts? Has something changed? I mean, the macro setup's been there all along, but what are you seeing out there, Sandeep?
Yeah, look, it's interesting, and yeah, we live it and breathe it every day. I mean, I think it's fair to say that even the second half of 2020, the risk trade was coming off a little bit, which is normal. There was talk of vaccines. The world was seemingly opening up, although it's been in first fits and starts. But certainly, the first 4 months of this year, you couldn't get anyone on the institutional side to care about gold. It's
right.
Every other sector was hot. Obviously, people were putting money into copper, putting money into Bitcoin, any kind of tech industry. And frankly, when you think about institutional investors, they can't really afford to be flat or down any quarter. They'll if there's a buck to be made in a specific quarter, they'll chase it that quarter. So I think that's something, that's some of what we saw hurt the gold price, and there was just constant outflows for certainly the first 4 months of this year. Whereas the thesis for gold hadn't really been hurt. It had just kind of continued to improve, but there was just better money, or at least the perception was that there was better money to be made in other sectors. And those things, if enough people believe in them, they become self-fulfilling, really. But when you think about the thesis for gold, you've got a situation where, and you have seen a bottoming out of that and kind of ticking back up in the last month or so with gold up, kind of almost $100, and interest coming back. And then when you look at the underpinnings of that thesis, you've got, global debt still massively high, 300 trillion, which is 3.5 times, give or take, the global GDP. So really, when you hear the Fed talk about inflation being temporary or transitory, this month or for April, we had a 4.2% CPI number. Mm-hmm. I think that's starting to ring a little hollow as self-serving and just plain false. And so I think you've got the inflation story coming in, you've got the debt story, which is high and increasing, and the Fed's ability to actually handle that is going to be limited, because I don't think they can let rates go much higher. So, I think the backdrop's still very good. When you think about, the canaries in the coal mine, really, you think about things like the Archegos blow up more recently, amazing amount of leverage that a small hedge fund was able to get. And when there's that much cheap money out there, frankly, the decisions that are made are poor. The bubbles that exist only get bigger, and then the repercussions for when they blow up are just massive and scary. And I think there's a lot of kind of telltale signs that the market's overheated in a lot of places. And frankly, gold's always been that safe haven. It's always been that hedge. It's been the case for millennia. It will continue to be the case. And I think we're seeing people kind of turn back their attention to that and start to put it back into their portfolio for that same reason.
Right. Yeah. I mean, interesting comment there. Actually, a thread I want to pull on when you said when there's that much money out there, weird decisions are made, right? And it reminds me of how much money there was in 2020 for royalty companies, specifically new ones, it seemed, right? And we saw this surge in new royalty companies launch in 2020 and even into 2021. You know what the most common question I get right now, Sandeep, whether in YouTube comments or even like in my Instagram DMs, is how do you vet a royalty company? Everybody wants to know. And there's more and more every day, it seems. So what would you have to say to somebody who's looking at, a list of 6, 8 new royalty companies, what should they be considering right now?
Yeah, look, there were a ton of new entrants, and there continue to be. There's new people all the time. I guess it was the summer, maybe third quarter of last year. There was a new one every week almost.
Yeah.
And look, some are doing better than others. Some will do better than others. So I don't want to disparage anyone in particular, but I would say as a group, you got to be careful, and that's a pretty trite statement about investing in the mining sector. But I think especially in kind of some of these new stories, again, without wanting to pick on people, a lot, when you think about the royalty sector, we're a pretty acquisitive group. It's our business to go out there and accumulate royalties and streams. It's a scalable business. It doesn't cost us any more in terms of people or infrastructure to do that. And many of the portfolios that you've seen come to market were available. They were all shopped to the whole lot of us that are quite competitive. And none of us chose to take them. So that should give you a little bit of pause, that you at least should do your work and look into the portfolios to see if you find value. But generally speaking, what we're seeing there is a lot of companies starting up, getting pretty fair value or full value for early stage assets. And so the work you need to do is to kind of determine as to whether you think those early stage assets are getting interest now because commodity prices are high, or they'll stand the test of time and actually get into production and generate revenue. So, I think you got to be careful, but that's true of all mining, I guess. The fact is, when you look at companies like us and in our peer group, the stability that you get from the cash flow that we're producing, and then all the torque that you get from our portfolios, I think is a healthier risk reward profile.
Yeah, and I think the narrative around royalty companies for the previous decade has been, they're appealing because of the decrease in downside risk, right? And that's true to a point, but now if you're sort of awash in new plays, who, to your point, the assets they're acquiring, you got to ask, why are those assets available when there were cashed up companies like yourself hunting over the last decade? Why did you not snap those up? You got to put that question really in the crosshairs a little bit. Is that still a blanket statement you can apply to royalty companies? And I don't think it is. So it's important that investors realize that.
No. I think, look, with any sector, when you have, that many new companies, some are just kind of taking advantage of the froth, but there are good companies trying to do good things. Not to say that we look at it, we can see everything at all times. So there's always going to be people that can go find value, which is good for the sector. But not all royalties are the same. So I think you need to do your work and make sure you're understanding what you're buying into.
Okay, so let's talk about what we're buying into with Osisko a little bit, because I had you on maybe 4 or 5 months ago and we caught up on some of the changes you'd implemented since taking over as CEO. You recently just put out your Q1 results. So what are some highlights we should focus on today for investors, Sandeep?
Sure. So from an Osisko Royalties perspective, I mean, the business is really just humming right now. It's doing exceptionally well. When you think of us, you should think of us as, significant and stable production today. So our midpoint of guidance for the year is 80,000 GEOs at a 97% cash margin. So best in class with long mine lives. Like, none of our assets are falling off anytime soon. Many of them are newer mines, so they got really long mine lives ahead of them. Our flagship asset just got significantly better, and I'm sure we'll talk about that. But a good, stable 80,000 ounces. And to that, every year we're adding new resources, new GEOs, new assets coming along. So a high amount of organic growth. We are predominantly Canadian and North American and America's focused. We are gold and silver, 80-20 basically is the split, a little bit of other in there. And we're partnered with some of the best operators in the business, but importantly partnered with them on very low cost mines. And mines that they're spending a lot of money on and making better every day. So the portfolio is really working well. You mentioned the Q1. In Q1, we had just a touch under 20,000 ounces of GEOs at that same margin, which sets us up really nicely for the year. I mentioned the midpoint's 80. We got 20 in the first quarter, but that was with one of our key assets being the Eagle Mine, really providing a low number, which we expected in Q1. They don't stack ore in the coldest months of the year in the Yukon. So we expect that production to really rev up for us. So it sets us up really nicely to have a strong 2021.
100%. Yeah, we've had John McConnell on the show a couple of times, so my audience is pretty up to speed with the Eagle Mine, Canada's newest producing gold mine. So Congrats on that agreement. And so let's talk about, your flagship, the Malartic, and what's changed with this asset recently.
Yeah, so we would have talked, I think, in late in the year, and I would have told you late in 2020 that we were expecting this catalyst. And I think we in the market were starting to expect that the underground decision at Canadian Malartic, the project is referred to as Odyssey sometimes, was going to be a go-ahead. It just looked too good not to go ahead. And the messaging, certainly from Agnico and Yamana, the operators, was in that direction. And then in early to mid-February, they made the construction decision. They're spending $1.3 billion to build the underground. We spend nothing, but we get about a 4.5% royalty on the underground as well. So 5% on the open pit, which runs to 2028, 2029, which is already the most valuable gold royalty in the entire business.
Yeah.
It's essentially doubled in value. They've pushed out the mine life to 2039. Importantly, that's just with 50% of the 14.5 million ounces that are underground there. So it's a massive deposit. 50% of those ounces get us out 2 decades. We firmly believe that once they get underground, they'll be able to infill drill much of the rest. And so that will grow the mine life. And they've put out some pretty stellar exploration results as well. They've been open that they think it's open at depth, especially our 5% royalty ground at East Goldie. Just in the last couple of weeks, they put out a 1,000-meter step-out hole, basically, that hit within meters of where they expected to hit it, and they hit the same type of grade and thickness. So, obviously, there's a lot of work to do there from an exploration perspective to connect the dots between a 1,000-meter step-out hole. But they're piling up ounces extremely quickly. We already have a 20-year asset, which is a flagship. It's continuing to get better. It will get longer. There's no doubt. The only question is how much longer it will get. And then the added upside to that is when they go traditionally or completely underground, it'll only be 20,000 tons per day out of a facility that can do mid 50,000 tons a day. So now we're starting to hear commentary, and it's conceptual in nature. It's early days, but we're hearing commentary from the operators that maybe there can be a second decline. Maybe there could be in time multiple shafts. They're certainly working on ideas to try to fill that mill as much as possible. So, I can't underestimate or I can't underscore how massive a catalyst that is for us. Our flagship was starting to feel a little bit finite till the end of this decade. Now it's been pushed out for 2 decades, and it's only getting longer and maybe getting bigger. So it's a pretty fantastic set of news for us. It happened in a down market. It happened in that period in the start of the year where it was just a giant sucking sound out of the gold sector. So we don't think we're getting anywhere near the amount of credit we deserve for that royalty, which, as I said, was already the most valuable in the world. It's by far the most valuable in the world today.
Yeah, no, I agree with you there that the market hasn't responded to that news yet. So what's it going to take, Sandeep? And any thoughts? What comes to mind when I look at the share price and I'm curious as to when the market will catch on to these new agreements. I mean, cash flow is cash flow. You guys are generating, I think it was 49 million in Q1. And as you said, 97% cash margin. It's crazy. You do have the most valuable royalty agreement in the business. That's expanded now. What else is going on in terms of upside that we can look forward to? I know your I guess call it like system-wide drilling programs are colossal, to the tune of like 1 million meters of drilling. Talk to me about this.
Yeah, so I'll get back to the value argument because you made a couple of good points there. We should talk about it, but let's touch on that piece first, I guess, on the upside. Yes, the portfolio is doing exceptionally well. The producing assets, they're outperforming. We're extremely pleased with our existing asset base. And as I said, long mine lives, we're not worried about any of it falling off. The development assets are coming along exceptionally well. But on the upside, whether it's producing or development assets, we do have the situation where we've had 1 million meters spent on our royalty grounds each of the last 4 years now, which is an absurd number. And
it's an absurd number.
And I've been using it, and I've been realizing that maybe it's a bit too absurd and needs a little bit of context. So Agnico, for instance, they drilled 750,000 meters last year on their entire portfolio. Agnico Eagle, obviously everybody knows, is a very successful, it's our partner, but a very successful, $20 billion circa company, known for creating value at the drill bit, right? Known for being the leader in the senior space on finding assets and drilling them out and making them better. So, that's a bit of a data point in terms of the million meters that we get drilled across our entire portfolio. The other way to think of it is we have a land package in aggregate that is akin to our larger peers on the royalty side, the largest peers on the royalty side, as well as some of the largest companies in the gold sector, period. So Newmont, for instance, has 50 some odd thousand kilometers of land in their portfolio. A 60 billion US market cap company, pretty good company by all accounts. In Canada alone, we've got 25,000 square kilometers of some of the most prospective belts in mining. So you need the land package, you need it to be prospective. We have that. You need people to be working on it. A million meters a year certainly counts as work, but more importantly, you need that work to be successful. And that's what we're seeing. I think across the board, our operators are, replacing reserves pretty easily. They're extending mine lives. There's certain cases of announcing expansions. New mines are being found, or existing projects are being made significantly bigger. So there's just good news across that entire portfolio, and we're getting the benefit of that for free, right? Because once you take on your royalty exposure, once you've paid for your exposure, anything else that's found thereafter, we benefit from disproportionately to the operators because we don't have any of the finding costs and we don't have any of the extraction costs. And that's the real kind of secret sauce of the royalty business. That's why a Franco-Nevada can trade at 2.5 times or 3 times in their history, is because there's always some asset that they've had in the portfolio for a really long time. They paid for a long time ago that's getting better. A new drill hole somewhere that makes something more interesting, a new asset that pops out of the woodwork. And as a maturing company now, 7 years old, that's not something we historically used to get the full benefit of, because we were always building a portfolio, right? Paying with each new asset, paying for some negotiated version of what that asset was. It's only with the passage of time, more work, more time, more money spent on those assets, do you get that upside. And Malartic Underground is a massive example of it, but it's happening almost across the board.
Right. Okay. And so back to the market waking up or sleeping on this news. So how do you perceive the reaction right now?
I think it's kind of normal. As I said, the catalyst we put out there happened in a bad market, right? The Osisko development spin-out transaction was in December 2020. The Malartic Underground was in February of 2021. Again, it was a giant sucking sound of dollars out of the mining sector, or the gold sector, I should say, at the time. That's now stemmed, and it's going back in the right direction for us. And we're seeing that changing. Even with that, we've still been one, if not the first and the second best performing royalty company since the start of 2020. We've just, it's been largely of late in a flat market, a flat to downward market, where we've just preserved our value better than some.
Right.
But when there's new dollars coming into the sector again, I think we're finding that we're getting our disproportionate share. There's people that we met with last year that at the start of the year when there was money in the sector, maybe we were a bit too complex for. Having fixed our complexity, we're now seeing people pop up on our shareholder roster, unbeknownst to us. There's not even an update meeting. We just see people popping up on the roster. And we firmly thought that we had done enough and that enough good had happened in the portfolio that was going to start to be the case. And it's nice to see that starting to happen. Even with that, we're still trading at about 1 times now. So there's a lot of room for the story to run. But I genuinely feel like we've kind of rounded that corner. And the people are seeing the value, and then they're acting on it. Okay,
I agree with you. Now, I want to give you the opportunity to talk about your ESG initiatives, because you guys walk the walk, and specifically with your position in Carbon Streaming Corp. And I'd love you to describe to the audience what Carbon Streaming Corp is, why you're involved, and what this does, most importantly, what this does for investor perspective and investor response.
Sure. And it's something we're quite pleased and proud to talk about. You're right. We've always done things the right way, or we've always tried to do things the right way from the ESG perspective. And if you don't really have a mining story, right? If you fail on environmental and social issues, you fail on mining, basically, especially in Canada with as much First Nations implications as on a lot of our assets. And the team that moved the town off a project in Quebec to build it, the Malartic mine, knows a thing or two about social license and what it takes to get things done. We've taken that into the royalty business. And obviously the way we use that is to diligence assets, to find the right partners to get involved with. And so diligence is a key factor, auditing, keeping up on things, just being in Canada, you'd almost think our portfolio was built with ESG in mind. In terms of where we are, where our assets are, who we're partnered with. Yeah. So that's just good business. I mean, and obviously we're charitable. I mean, if we weren't charitable in our professional and personal lives, given, how successful we've been and how lucky we've been, shame on us. So, but for us, those are kind of like, that's just waking up in the morning and brushing your teeth almost. It's a given. The amount of emphasis that's being placed on ESG, especially by the institutional side, is massive and it's growing. And we want it to be a leader, not a laggard in that business. Again, as I said, we always try to conduct ourselves the best way. We're catching up and we've caught up on our disclosure side, which maybe was a bit lacking. We weren't crowing about our achievements in our portfolio enough. We'll do better at that. Okay. And then we also thought, what can we do? Because we can't reduce our carbon footprint directly, right? We don't run the mine. We count on our partners to do that. But what can we do to be active in this space? And that's how we came into that investment and partnership with Carbon Streaming Corp, a private company going public soon, run by a guy named Justin Cochran, who's known in the streaming space. He's had several successes in that space, and he's taken that knowledge to the carbon sector, which is a massive sector, and it's one that's growing leaps and bounds. So basically, through a small investment, we own about 15% of the company, and we also bought ourselves the right to participate in their deals. And their deals will look much like streaming deals in the mining sector. Instead of pre-funding a mining project, they will pre-fund a carbon offset project anywhere in the world. So carbon sequestration project or biodiversity project, something that generates good, and in generating good and climate reduction benefits from carbon credits that then can be sold for value. So for us, it was accretive. We think there's a lot of value in these transactions that they're looking into. It's a nascent business, and we bought ourselves a front row ticket for it. And it also helps to reduce our indirect footprint. So, we can tell investors, you guys have to justify your carbon footprint. We are at the end of the day an investor, so we're going to do the same. And we're actively looking to fund things that will do good and also reduce our footprint at the same time. And when you think about the royalty sector and the precious metal royalty sector, everybody's got an other basket right outside of precious metals. Where ours is quite small for the time being. We're 95% precious metal, gold and silver. Right. Everyone's got something other that they're doing, whether it's oil and gas or cobalt or anything else. We just felt in our other basket, if we could put something that's actually green and benefiting society, and we can make a return and a better return doing it, that seemed like a good idea.
100%. Yeah. And more a requirement for institutional money, right? I get it. So I love it, Sandeep. Look, thanks for coming back on. It's great to catch up with you again and get a look behind the kimono. Once again, congrats on the Q1 results. Phenomenal.
Thank you.
I look forward to catching up again soon.
It's always a good chat, Jay, and thanks for the time. Thanks to your listeners. And I'll just end by saying, momentum matters in all aspects of life, and certainly in the market. And we have it. I mean, whether it's at the asset base, things are just humming along. Couldn't be happier with how things are moving. The development pipeline, we didn't talk about it, but we also own $1 billion of equities essentially in other public companies, some of the better development assets in the space. So that adds a lot of leverage to a rising gold price, more so than any of our peers. So the business is doing exceptionally well. Our shareholder base is getting it. We're attracting new shareholders every day, and I think it's a good time for your listeners to be looking at us. So thanks for the effort.
I agree. Okay. Thank you, Sandeep.
Okay. Be well.
As always, if you enjoy this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.